This is how to calculate the intrinsic value of a stock using 5 very simple steps. Watch closely because once you learn this method, you'll be able to tell which stocks are cheap and which ones are way overpriced. Every great investor knows how to calculate intrinsic value, they just don't share how to do it. Let's change that. The good news is it's not that hard. The bad news is you might find yourself quitting your job and living purely off of passive stock income. Step 1 is we need to calculate the free cash flow of the stock. Warren Buffett says that the intrinsic value of a stock is the discounted value of the cash that can be taken out of a business during its remaining life. Sounds complicated, but it just means how much cash is this stock or business going to produce for us. To work this out, we first need to know, well, what is the current free cash flow? This is easy. Go to buffettinvestors.com. I'll use Apple stock as an example. Click on Apple stock, scroll down, and you can see the free cash flow right here. This tells you how much cash Apple has generated over the past year. Pro tip, every now and then you'll see a free cash flow that is skewed. For example, the company decided to spend a lot on R&D that year. Okay, no problem. You can adjust the starting free cash flow here to a more appropriate figure. But right now, Apple's free cash flow is quite consistent, so no need to adjust with this stock. Step 2, you need to work out how many years you want to forecast for. For this calculation, we're going to do a 10-year forecast. Step 3 is you need to work out that cash flow's future growth rate. To work out future growth rate, well, I like to look at, how has cash grown by in the past? Buffett Investors shows you this information right here. Right now, Apple's cash flow has grown by 15% over the prior 10 years. So let's assume that in the future, Apple grows at a slower rate compared to the past. Let's say 10%. As companies mature, they tend to grow slower. So 10% is more reasonable than 15%. Now, of course, this figure can be hard to accurately predict. And this is where it comes in handy, understanding the business. If you truly understand the business, you're going to have a much better feel for how much the growth will be in the future. So eat your vegetables and read those annual reports to grow your understanding. But a little hack that you can use as a second source to get your growth rate is by checking analyst expectations. Go to stockanalysis.com, type in Apple stock, go to the forecast section, scroll down, and you can see that about 40 or so analysts also expect Apple's earnings to grow by around that 10% mark. Step 4 is we need to work out at what percent are we going to discount the future cash flows by. This is how we work out the present value of the future cash flows. I like to use a 10% discount rate as I want at least a 10% return on my investment. The final step is terminal PE multiple. At what multiple of the free cash flow will we sell the stock for in 10 years' time? To work this out, I like to look at the current PE multiple and then assume that in 10 years' time it's going to be much lower. Right now, Apple's current PE multiple is 32. Let's assume that in 10 years it's much lower at 20. If you want, you can check this over by looking at the historical PE ratio of the stock, then see what is the average and what may this look like in 10 years' time. Will it be at the average still? I'm going to decide to keep this number at 20 though. That's all we need. Click calculate. And we can see that Apple has an intrinsic value of $190 per share, which is pretty much at fair value. That's just 3% below the current price of $195. And there you go, you've just calculated Apple's intrinsic value. As per Warren Buffett's definition, we have discounted the future cash flows of the business into the present. Also, don't worry about being too precise with this number. What you want is a rough estimate of the stock's value. As Buffett says, I'd rather be approximately right than precisely wrong. So that value is the approximate value of the stock, not the exact figure. Okay, I want to shore up this process by going over the same steps with a different stock. Shall we do Google? Step 1, get the cash flow over here. Step 2, we'll do a 10-year forecast. Step 3, Google has grown cash flow at an average rate of 18% over the last 10 years. Let's assume in the future that slows down to 12%. Google's so big already, it's going to be hard to maintain previous growth rates. Step 4, we'll use a 10% discount rate. And step 5, Google's current PE multiple is 26. In 10 years' time, if the market behaves itself, which we never know, but let's assume that we'll sell it for a multiple of 18. Calculate, and we can see that Google has an intrinsic value of $198 a share, quite a bit higher than the price, which is $133. Or the intrinsic market cap is $2.5 trillion compared to the $1.7 trillion it's currently selling for. And that's the process. Congrats, you're no longer part of the herd who knows the price of everything but the value of nothing.